told him, and then I told you, and I'm going to tell you again, the best advice that I have for a newer investor is to do something called dollar cost averaging, which is a very simple strategy. Essentially, you pick something and you say, hey, I'm going to consistently invest in it every blah, 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 blah. And why I think this is the best approach for new investors is because, well, typically new investors have two main fears, right? And these are normal fears, so don't feel bad if I'm talking to you when I start mentioning them. But the first fear is like, what the heck do I invest in? There's all this stuff out here, right? There's millions and millions and millions of things, maybe not millions, but you get what I'm saying, of assets that I can invest in. How do I know what to pick? And then two, when do I trade them or when do I invest in them, right? So what to invest in and then the timing. Those are the two fears. And what's cool about dollar cost averaging is it kind of cuts out. Hit myself. Gosh, dang it. That hurt. The cool thing about dollar cost averaging is it allows you to really simply bypass these fears, right? So to answer the first fear, what do I invest in, right? If you're going to dollar cost average, obviously you can do it in everything or anything, but you probably want to start off with some type of investment fund. So the S&P 500 is a great example. That is like the go-to. If you look at the chart in front of you, you will see that the S&P 500 just goes up. It takes little dips down like everything in the market, but in general, it goes from the bottom left of your screen to the top right of your screen, which we know is all signs of a strong bullish trend. So this thing will go up. It's also 500 great companies. So boom, there you go. You got your hedging, you got your diversification right there. You don't have to pick and choose what you think is the best. Just invest in the thing that has all of the best. It's an all-star team pretty much. And then as far as the timing component goes, right, we talked about with dollar cost averaging, right? What you're trying to do is you're trying to invest on a consistent basis, right? At least in step one, you're not really trying to time the market. You're just saying, hey, at the first of each month, I'm going to put $200 into the S&P. So January 1st, throw $200 in there. February 1st, throw $200 in there. March 1st, I have money lying around because I'm a trader. Yeah, look at that. Look, just throw $200 into it. I should make sure I don't lose that. I did that before and I actually lost some of the money that I threw during this video. I think a kid took it. Anyway, so it takes the timing component out of it. You're just trying to be consistent. You're consistently kind of slowly building a position in this thing. You don't need to worry about the timing. So both of those fears that I told you about earlier, boom, they're gone.